Welcome everyone to Walk the Talk Real Estate. I'm your host, Rick Fredrick. And today I wanted to share with you guys a little bit about PPI, CPI, PCE. What do those terms really mean? Why do they really matter? And especially if you're buying a home, why does it really matter? You know, I hear on the radio all the time just about how inflation is out of control and what's the Fed doing. So I thought it'd be a good idea to bring in an expert. And today I'm happy to have join me Carter Seidel. He's with Seidel Mortgage Group. Carter's a senior mortgage banker and broker. He's got a background in international finance. So he's a great person to sort of fill in the blanks and give us a good idea of what all of this really means. So Carter, thanks for joining today.
Absolutely, Rick. Thank you for having me.
Great. Well, you know, Carter, I look at just the past, and we had that big jump in gas prices. You saw about the same time, I think they went up to what, $6 a gallon or something. Grocery bills were probably up 50% or more, depending on, you know, who you were. And we saw the Fed take some drastic action. But before we sort of jump into what they did, I thought it might be a good idea to just sort of take a step back and help people understand what's the Fed's role? What is their role in the economy, and what do they do to really impact things that can have a correlation between buying a house and interest rates?
Yeah, so I guess the best place to start is kind of just going over what the Federal Reserve is, because I know that's a hot topic word, and I'm sure a lot of people kind of have an idea, but maybe aren't too sure of the fine details. The Federal Reserve is just the central bank of the United States. You know, it's arguably one of the most powerful financial institutions in the world. Some of their duties include just conducting monetary policy, supervising and regulating banks, maintaining financial stability, which is what you've seen happen over with these rate hikes, is them trying to do that, and just providing banking services. So that's kind of encompassing what the Federal Reserve's role is.
All right, great. And then, so what do they do? Like, what do they do in the marketplace that actually can move the market? You know, you hear the Fed's meeting, they're going to raise interest rates. But how do they actually do that? What does that look like?
Yeah, so what they're doing when they're raising a rate is it's their federal funds rate. And so that's essentially the interest rate that depository institutions, banks, and then savings and loans and credit unions are charged for overnight loans. And then just kind of get into that, overnight loan is essentially just a loan that a bank makes to another bank for a short period of time. So it's that short-term lending, which is the rate that they're raising. So you'll see that on credit institutions, so your credit cards and stuff like that. It's directly affecting stuff like that, and savings and loans and stuff that you have through the bank.
So do they have to, or I guess, do the banks loan each other money because they have to keep a certain amount of cash on hand?
Yeah, I mean, our banking system's fractal. So, you know, there's never going to be, you put in $1 million, that bank might not have $1 million on hand all the time. So the banks are always loaning and borrowing money from people, from other banks.
Okay, great. Well, then how does all of that activity that the Fed does, how does it tie into the CPI, PCE, and maybe talk about those terms and what they mean and how that ties into interest rates?
Yeah, so when inflation starts to go up, some measures that the Fed will look at to kind of measure inflation. One of them is your CPI, which is your Consumer Price Index, which basically just measures overall change in consumer prices, and that's based on a basket of goods and services over time. There's about 94,000 price quotes collected monthly. It's where they gather that data from, and that comes from retail, service establishments, and rental housing units. Of that or of that CPI, what they really focus on is core CPI, because that takes out gas and food, which is something that the Fed really doesn't have much control over. So that number is a lot more beneficial for them because those are the items that they can actually have influence on. Now, the primary figure in inflation kind of unit that they really focus on is PCE, which is the personal consumption expenditure. And so somewhat similar to CPI, it's a measure of spending on goods and services by the people of the United States. The figures that they get from these can make this affect decisions on business offerings, hiring, and investments and stuff like that. So this is the preferred method by the Fed for inflation measure. It's just broader and more robust measure of inflation, less volatile.
So I guess, for people that are wanting to buy or sell a home, I mean, if your home goes up in value, I feel like that's a pretty good thing. So, I guess, how does that all tie, the consumer price index or the PCE? How does that tie into interest rates? And, I see, inflation goes up and, typically you see interest rates go up. So where's the tie there, and how to bring that all together for us?
Yeah. So, I mean, to break it down, I mean, inflation is just at its basis, too many dollars for too few of goods. So, inflation's not necessarily a bad thing, depending which side of the ball you're on. If you have investments like property and stock commodities and stuff like that, well, inflation's been pretty good. You've made a pretty good penny, aside from kind of midway last year, from about third quarter of 2020 all the way up to about maybe the first quarter of 2022. You're making a good amount of money on either your property or your stocks and stuff like that. So that's kind of the beneficial side of inflation. Now, on the other side, if you're wanting to buy a home or if you're wanting to get into those stocks, well, that's when you're like, this kind of sucks. I don't like this because now everything I want to buy is a lot more money. So basically what the Fed does with that is they raise their interest rates so that it makes borrowing money more costly. So through that whole period of 2020 through the beginning of 2022, there wasn't they weren't really incentivizing saving money. They were wanting you to spend money because they needed the economy to catch back up from the COVID and everything like that. So them raising interest rates basically forces everyone into saving their money a lot more, costs more money to do certain things. So that's pulling dollars out of the market, which, like I said, inflation is too many dollars for too little goods. How do you fix that? You take those dollars out of the market, and inevitably the supply and demand weighs itself out there.
So I guess the other thing that I heard is that as it relates to that, the Federal Reserve is actually wanting people to lose their jobs. Can you talk a little bit about that and sort of how does that play into overseeing the health of the economy?
Yeah, it's kind of messed up to think about on paper. They're really wanting some blood in the streets. They need to see that the market's cooling. They need to see that there's truly the rates are taking effect, because when they raise those rates, that corporate borrowing and stuff like that all these companies have, well, it costs more money for them to borrow, which means that they have to cut costs somewhere, which means that usually comes at the expense of their employees. So that's why you're seeing all these layoffs, because it's becoming more costly to run their business because the rates that they borrow are going up. And so the Fed wants to see that, because that means that their rates, these hikes, are actually having an effect on the market.
So that means, obviously, if more people are out of work, that means you have less people chasing those goods. So I guess that would mean less demand. So if you have fewer people chasing all of these different things we can go out there and spend money on, then I would think that that's going to help lower inflation. Is that right?
Yeah, because again, it sounds repetitive, but inflation is just too many dollars for too little goods. You have a bunch of layoffs, then that's another way of taking the money out of the market there. It's people aren't making money, so they can't be putting money into the market. And so if anything, they're saving their money. And then seeing all these layoffs, I'm sure, is also kind of forcing people to think about their spending a little bit more, because, it's that what if that happens to me scenario. So just all things that are going to keep people a little tighter to their vest with their cash.
So then, looking at all of this and how it impacts people out there that are wanting to either buy or sell a house or a home, I'm thinking, when would be a good time? What signs, I guess, can you see in the marketplace that, okay, the Fed's not going to continue to raise rates, or they're not going to be, it's not going to be as I guess anxious, or people are actually going to have some clarity. There won't be so much uncertainty. So what are things we, as just the novice homeowner, can look for out there to see that, okay, this might be an okay time, the Fed's not going to do anything more?
Yeah, I mean, everyone has the option to kind of monitor, and monthly numbers that come out, like CPI and PCE. For example, PCE numbers come out tomorrow. And so, if you kind of have a pulse on that and kind of know at least what they're forecasting and stuff like that, you can see those numbers and know, if it's, I think, so PCE numbers come out tomorrow. I think they're forecasting, just as last month, 0% for that. So 0% means that those the personal consumption expenditure and the spending on goods has not increased at all. So that's kind of a sign that shows that the market's going down, which means that the Fed kind of looks at that and thinks, okay, we don't have to be as aggressive with our rate hikes, because they're taking effect, they're working in aspects of the market. So following stuff like that's good. Helps you just kind of know why, if rates are going up, this is why. But to kind of also side note, for mortgages, the Fed doesn't have a direct effect on our interest rates. So our interest rates are based off of UMBS, which is Unified Mortgage-Backed Securities, which are bonds. So those are pass-through securities. Each are representing kind of undivided interest in a pool of residential mortgages. So that pool is made up of Freddie Mac loans of 30-year, 20-year, 15 and 10-year fully amortizing mortgages. So when interest rates go up, that means that bond prices are going down. So there's an inverse kind of relationship there. So when people are selling off their bonds and stuff like that, that's making the yield on them go up, which is making the interest rates go up, and vice versa. When people are starting to buy back into bonds, then interest rates go down because the yield goes down. So that's essentially what mortgage rates are traded off of. And now I'm not saying that doesn't have an effect at all from what the Fed does, because how aggressive or inaggressive the Fed is being will affect how these bond traders trade. So if they think it's going to be 25 basis points and then maybe tapering off to nothing, they're going to be a lot more aggressive in buying bonds. But if they think it's going to be 75 basis points, you'll see a big sell-off, and then your interest rate will go up.
Okay.
So it's not directly a 25%, 25%, 75%, 75%. One going up will likely cause the other to go up, but it won't be by that same increment.
Okay. So yeah, it's sort of how much, I guess, how good is the investment on what they're buying or selling, and they're anticipating what the Fed may or may not do. Like you said, if they think the Fed's going to raise rates, well, then, they probably want to hold securities or instruments that have a higher interest rate, and anything with a lower interest rate isn't going to be worth as much, because I could go out. It's like if you're selling a car that is older and everyone wants one, and then all of a sudden they don't, which that's sort of what we saw over the pandemic as well. Used car prices went through the roof, almost as much as new cars. And then now that demand has really waned. I think it's gone a lot. So I guess that's, what people would look for, or investors would look for, as far as mortgage-backed securities. If they can get a better rate somewhere, then they want to sell maybe what they own and buy something that has a higher return. Is that sort of
absolutely. Yeah, that's a great example of that. So, but yeah, so that's kind of how our rates are affected. So yes, when the Fed does raise rates, it does affect us. It's just not the exact amount that the Fed is actually raising rates. So,
okay. Well then, so what else can you think of that people should know as far as just the Federal Reserve and inflation, and as far as, you know, trying to time? I mean, you've got market experts out there that try to time these things, and they're not always right. So as a novice homeowner that's trying to time the market, what would be your, I guess, suggestion, or what would be your advice to those folks that are trying
yeah,
to?
there's the old adage of time in the market is better than timing the market. So, there's truly never a great time to buy, and there's truly never a terrible time to buy. Because, say interest rates go all the way down to, and I don't think it's going to happen anytime soon, and we really shouldn't want it to happen, but say they go back down to 3.5%. Well, you have all this supply of people who are going to flood the market, and you're going to be overpaying for homes. You're not going to get any seller incentives anymore just because there's so many offers. Sellers don't need to do that. And then you have the other side of the coin, they go up to 7%. Well, yeah, you're paying more monthly, but there are almost, 95% of the buyers who are in the market are now gone. You're getting seller concessions. You're getting all sorts of stuff that you wouldn't have got on the other side. So really, there's never a bad time to buy, especially if you're in a good market like we are in Dallas. You're always going to have appreciation. It's going to vary where you are, but you're still going to gain appreciation. You can always write off the interest on your home. And, there's just so many things you can do, especially if you're renting. There's truly never a bad time to buy than throwing money down a hole and renting.
Right. And I guess even if interest rates are high, you can definitely refinance when they come back down.
Yeah, absolutely. You can also say they're at 7%. You can also buy down on the rate through a permanent buy down. I know builders and some realtors and stuff are offering 2-1 buy downs, which is different than a permanent, just because that money is held in escrow and artificially lowering your monthly payments, and it's not really paid to the bank to buy down your rate. But the benefit of that is if you do a 2-1, you can always refi and you get whatever money in that escrow account back to you, opposed to a permanent buy down. Say you buy from 7 to 6, and then in a year and a half, rates are at 5.5, and you want to refi, you don't get that money back. So, yeah, I mean, there's really, no matter what the market's like, you can find ways to make it beneficial and serve you well. So, but as far as kind of the other Fed roles, as we said earlier, their main roles are conducting monetary policy, regulating banks, maintaining financial stability. And so one of the main monetary policies that they've implemented over the past 2 years, and they did it after the financial crisis, is the quantitative easing, where they artificially lower rates by purchasing bonds and other financial instruments such as mortgage-backed securities. So they do all that to artificially lower the interest rate to incentivize people going out and spending money, whether that be getting a loan or whatever you have there. And so traditionally, inflation rates and the 10-year bond, or the 10-year yield, which is kind of where our interest rates are off of. I think there's like a 2% premium on top of that, and that's typically where rates are. They follow each other. Inflation goes up, then the 10-year goes up. Inflation goes down, the 10-year goes down. So when you artificially lower that, and it's staying at a base level of almost zero while inflation's going up, well, once you taper off from doing that, well, it's got to catch back up to where inflation is. So that's why in the beginning of 2022, we saw such an aggressive jump in mortgage rates, because it had that much further to go, because it had been suppressed so long while inflation was taking off. So, I have a lot of people ask about, do I think we're going to see another jump like that? No, I don't. I think the bulk of the jump already happened, and that's something that, had to take place because it had to get back up there. So, inflation was soaring and we were artificially lowering. So it was a sizable jump to get back up.
Okay, great. Well, listen, anything else you can think of that listeners and viewers out there might be able to sort of glean some great information from, to assist them when they're buying or selling a home?
Yeah, I mean, just to start off, I think now is kind of the Goldilocks period for buying a home. Rates. Our check this morning, my rate was a 5.75, so it's still a good rate traditionally. Great rate, honestly.
Yeah,
And
substantially less than 7.5 that I think
yeah,
people still think we're at, or even 6.5.
absolutely. Yeah, I think people were so defeated and beaten down that they kind of stopped looking for a while. So you have that. You have a decent amount of supply. There's usually a good amount of supply every year from January to about May, just because people are trying to move and get into different school districts and stuff like that. So you've got good rates right now. You've got a good amount of supply coming on the market. And then you also have a lot of people who just aren't looking right now, just because of how the past year went. They just kind of blocked it out. They don't want to look. So you're kind of getting the best of both worlds, a lot of supply, not a ton of, and you're starting to get a little more multi offers on stuff, but not like it was before. You're still getting some seller concessions and you've got a pretty good rate. So I would just tell people to kind of, if you're looking and you were kind of hesitant because of how the past year and a half went, I get it. I was also looking for a home. I've been in that market too. It can be very defeating, but take a look back in, take a look at the neighborhood you were looking at. You'll see that there's starting to be a lot more supply than there was prior. And, rates aren't 7.5 anymore. So.
Right. Well, great. Well, listen, this has been very informative and I really appreciate you taking the time. Are there anything else you can think of that we haven't covered that we should?
No, I mean, that's really it. I mean, we could go into
well, we could probably talk all day about
yeah, a little bit more, but no one wants to hear that. That's not very fun.
Well, great. Well, listen, for Carter and the Seidel Mortgage Group, I'm Rick Fredrick, and we really appreciate your time.
See y'all.